Welcome to another Stock Hacker Academy video. Today we're going to talk about how you can rent to own your shares. If you're a real estate investor, you'll understand what rent to own is, but you might not understand how you do that with stocks. You can create cash flow on stocks you already own. How? Use a strategy called covered calls. Now we've explained covered calls in previous videos, options for beginners part 2 and part 3, 2 and 3. But we cover several topics in those videos. So this video is specifically to unpack what covered calls are and to give it that real estate investing comparison so that you might be able to latch on a little bit further. Before we get into that, the nitty gritty of covered calls though, it's important for you to define what your goal is here. You want to make more money, retire early, retire comfortably, fund vacation, or maybe even fund further investments. Maybe we have something that will help. It's called The Ultimate Side Hustle for Canadians. It's a free case study. If you sign up now, links in the description below. It's the full breakdown of MLM, Amazon e-commerce, real estate, and stock hacking. We just compare the amount of time and money needed to get into those side hustles and then the return from those as well. So if you want that free case study, the link is in the bio. But let's keep going on to covered calls. So rent to own, if you're a real estate investor or have studied real estate at all, you'll be familiar with this concept. If you're not, let's break it down a little bit. What is rent to own? It's a unique real estate investing strategy. It allows you to make money in actually several different ways. You find what's called a tenant buyer who can't quite qualify for a home, but they do have some funds saved up for a down payment. You can then find a property that you or a partner qualifies for the mortgage on. That tenant buyer, so you're pairing the tenant buyer with the property. The tenant buyer pays you the option consideration. It's what they've saved up for their down payment upfront. It's this premium upfront that they pay you. This is their share of the down payment. Each month, they rent the property from you and pay a premium on that rent that also goes towards the purchase of their home. Usually there's about a 2 or 3 year term on these rent to own deals as well. And it's a preset agreement. It's an option contract with your tenant buyer, and the purchase price, the future purchase price is already defined. It's set out, it's written in this contract. That's something that you've agreed to. The term of it, the 2 or 3 year term is also defined. Their option consideration is defined. And they essentially, you get to rent out a house that essentially they will take care of, and you don't have to worry about the usual headaches of being a landlord because this house is going to be theirs down the road. That's the intent. Covered calls are similar in nature. Okay, there's an asset, an underlying asset. So in the rent to own option, it's the house. With covered calls, it's stocks. A call is an option contract. Again, that's explained in past videos. A call is an option contract. The buyer of this contract, they want the right to buy your stock, your asset, underlying asset from you at a specific price. So it's kind of like the house. They're setting what that future purchase price is going to be. Well, you can do the same thing with the stocks under contract. And they want to set a term on this. So there's an expiry date. Same thing with the rent to own deal. For that right, they're going to pay you, you being the call option seller, they're going to pay you a premium up front. It's kind of like the option consideration premium in a rent to own deal. Okay, so there's several forms of profit here. Let's outline a specific example. So let's say you own shares of XYZ company, okay? $93 is your average cost for these shares. Maybe you're willing to sell those shares for $107. So you sell this covered call with the strike price, that future selling price at $107. And the term for this is 31 days. So this contract will expire in 31 days. For that right, for someone to buy those shares from you at 107, they're going to pay you a premium upfront of, let's say, 50 cents per share. Now, because every option contract is 100 shares, and again, if If these terms or these concepts are brand spanking new to you, visit options options for beginners series, and we outline a lot of this basics. So I'm going to kind of go through a lot of this terminology, assuming there's a basic understanding. In any case, because every option contract is 100 shares, that 50 cents per share premium is $50. That's cash in your pocket right up front. If XYZ stock reaches or surpasses $107 when the expiry date comes, your shares get called away. You sell them at $107 and you keep that premium. So not only did you make money on the sale, you also made a little extra on that premium. This is one of those stock hacking strategies that we talk about in the Ultimate Side Hustle for Canadians case study. So let's go piece by piece here and compare rent to own to cover calls. So you have the purchase price and the strike price, that future selling price. In the rent to own contract, you're agreeing to sell the house at a specific price by a specific date. Same thing with stocks, with cover calls. You're selling the stock at a specific price by a specific date. There's the option term, or in the cover call side, it's the expiry date. And again, there's a specific lifetime to this contract. There's the option consideration for the rent to own deal. That's the call premium. It's what's being paid up front. And there's the underlying asset, house, stocks. So how do you cash flow on stocks with covered calls? This is the juicy stuff, okay? Well, there's the call premium. That's in your account right away, no matter what. If your shares are called away, there's profit on the shares. Now, here's the interesting part. If the shares aren't called away, if the buyer doesn't buy, you keep them, but you also keep the premium. So let's say that stock price never hits 107, they don't get called away. That condition isn't met. They don't get called away. And you keep the $50 and you can write another covered call. You can start to do this over and over again. You have to have those 100 shares. That's important. So there always has to be that underlying asset. But if they're just sitting there in your account, why not make a little bit of extra money off them? Here's a really interesting tip. You can actually do this in registered funds accounts too. So TFSA and RRSPs. So what do you do with all this? It takes a lot of time to wrap your heads around it. Again, options for beginners series is there for you if you want. We also have done many other videos on specific stock deep dives. So it's just a matter of immersing yourself into this atmosphere. You can also download that Ultimate Side Hustle for Canadians case study if you want. The links in the bio to see how stock hacking lines up against, say, something like real estate investing, if you're familiar with real estate investing, and see what the numbers are, what the time investment is versus in real estate versus what it is in stock hacking. There are a lot of parallels here, and we're actually going to explore more of these parallels in future videos. But for now, just keep studying, and we'll see you later.